Okay, let's unpack this. For years, U.S. crypto projects, well, if they wanted to launch a token, they basically had two options.
Right. Go offshore or stick with VCs and these massive chaotic airdrops.
Exactly. And U.S. retail investors were essentially shut out of primary offerings. But now, Coinbase is stepping in. They're bringing token issuance back onshore with this brand new, highly regulated platform.
It's a huge deal. This isn't just a new feature.
No, it feels like a genuine reset button.
It really is a seismic shift. When you look at the industry's trajectory, this move signals a transition from, the Wild West of 2017
The ICO era.
straight to Wall Street with a Wallet Connect. It's about creating a clear, rules-based framework.
So our mission today is a deep dive into what Coinbase is calling token launches. We're calling it ICOs 2.0. We need to understand this regulated framework, how it's different, and what it really means for you.
Whether you're a retail investor or a founder looking for a compliant path to market.
So let's get right to the core of it. What does this platform actually look like, and how is it so different from the free-for-all we saw back in the day? The big headline is, U.S. retail is back in the game.
That's the critical difference. This is an end-to-end token sales platform built for verified Coinbase users, all under a regulated, transparent system. And the structure is very methodical. They're planning, one token sale per month, starting with Monad's MON token.
And how do people get in? Is it just first come, first served chaos like the old days?
Not at all. Verified Coinbase users submit a purchase request with USDC. But the allocation mechanism is what's fascinating here. It's explicitly designed to promote fairness.
Tell me about this fairness mechanism, because that's where the rubber meets the road.
Yeah.
In the old cycles, it always felt like the big funds ate first.
That's precisely the behavior they're trying to counteract. The allocation algorithm is bottom-up. Smaller purchase request ticket sizes range from $100 up to $100,000. They get priority.
Okay, that sounds great on paper. But what stops a whale with $100,000 from just splitting that into 1,000 separate $100 requests to game the system?
That's a valid question. And the platform has things like KYC and the single request process tied to your account to mitigate that. But the deeper enforcement mechanism, it really relies on the loyalty program.
Ah, the on-chain reputation score. This
Yeah.
is the part that feels like a real evolution, not just another rule. How does that loyalty system work?
Well, Coinbase is actively trying to extinguish that mint dump brag culture.
Yeah.
If you get an allocation and immediately sell it, you'll face reduced access, maybe even get excluded from future launches.
Oh.
But if you hold, you demonstrate commitment, and you gain priority for future sales, it introduces real discipline.
So they're basically saying if you want access to the best deals, you need to prove you're not just here for a quick flip. But to be critical, does this just move the dump from the TGE to, say, T plus 6 months?
It certainly discourages the immediate dump, but the goal is deeper. This discipline applies to the projects, too. Founders face mandatory 6-month token lockups, and they can't secretly offload allocations in OTC deals without full disclosure.
So that protects users from the founding team pulling the rug.
Exactly. So for you, the user, the promise is structured early access, transparent pricing, and less risk of insiders dumping on you.
And for founders.
A cleaner, compliant path to raise capital from verified U.S. participants. And the huge prize: an instant listing and deep liquidity on the Coinbase CEX.
Right, that instant path to liquidity is the ultimate goal. Which brings us to the famous Coinbase listing standards. To even qualify for this new launch platform, a project has to be listing ready. So walk us through that gauntlet.
Yeah, the CEX listing is the goal. It connects a project to a platform known for trust and compliance. And Coinbase insists the process is free, it's merit-based, and it is absolutely rigorous. It's not about paying to play.
Okay, so we know timelines can vary like crazy. What are the key stages after a project submits its application?
The whole process funnels down through 3 main stages. You start with a business evaluation.
So market demand, community traction, that sort of thing.
Right. But the really defining part is the core review. That's where the project faces the triple threat of legal compliance and technical security teams.
Okay, let's focus on that core review because you can really see the influence of the SEC here. What is the legal team looking for?
The legal team's job is a continuous, high-stakes, high-wire act. They are meticulously examining whether trading the token could be seen as an unregistered security.
And since Coinbase doesn't list securities.
This is where a project's application lives or dies.
So once they pass that securities hurdle, what's next? What does compliance look at?
The Compliance and Risk Mitigation Review zeroes in on the token's distribution and its on-chain history. They're hunting for red flags, financial crime, money laundering risk, anything that puts consumers in danger.
And then on the tech side, especially for a totally new layer 1 like Monad, that audit must be exhaustive.
It has to be. The technical security check isn't just about auditing the smart contract code, it's a deep dive. For a new blockchain, they're evaluating everything: the consensus mechanism, network resilience, the governance model. Can Coinbase even safely custody this thing at scale?
So if a team is well prepared, what are some of the common, maybe even silly pitfalls that still cause major delays?
One of the biggest roadblocks is public statements. Project teams just have to avoid promising that their asset is going to the moon or will generate huge profits. That kind of talk is a compliance nightmare.
Right. Focus on utility, not price action. What else is a deal breaker?
Centralized control is huge. If the protocol's architecture gives a small group too much power.
Like a simple multi-sig that can just upgrade everything?
Exactly. Or seize funds. That often leads to a rejection. They want projects that minimize single points of failure.
So let's say a project clears all these hurdles. What's a realistic timeline before trading goes live?
If due diligence is successful, the assessment can take about a week, and trading can be enabled within 2 weeks of approval. But that's only for tokens on supported networks like Ethereum or Solana. A new chain takes much longer. It needs dedicated engineering work.
And once it's approved, the launch itself is very structured.
Very. It's a phased process to protect the market. It starts with transfer only to build liquidity, then a short auction period to find a price.
At least 10 minutes.
At least 10 minutes. Only then does it move to full trading. They're ensuring a soft landing, not a crash landing.
It's pretty clear this whole platform is Coinbase's answer to the current regulatory pressure cooker in the US.
It is. But what's really fascinating is what this means for community growth models. I mean, for the past few years, the default method has been the airdrop.
Which, let's be honest, has mostly devolved into.
Sybil-farmed entitlement events. Exactly. Bots and professional farmers dominate, and you rarely get a quality community out of it.
And this gives founders a clean exit from that airdrop chaos. They can raise capital from verified, real users.
Precisely. Look at the supply distribution for Monad. They're giving about 3.3% to airdrop recipients, which is standard, but they've allocated a much larger 7.5% to this token sale. The message is clear. Serious ownership now has a price tag.
So, if this model takes off over the next year, what should the community be bracing for?
I think you should expect to see a steady flow of high-quality, fully vetted projects choosing this path.
Over the riskier offshore platforms.
Right. And it gives U.S. retail structured, compliant access to early-stage crypto again. And crucially, we should see institutions start circling this like a shiny new IPO window. This is where big money finds comfort.
This whole shift towards compliance as an advantage sounds incredibly positive for the market. But what are the friction points? What are the risks?
Well, this raises an important question for the industry's soul, really. Does this rigid new framework with its corporate dress code and compliance, does it lead to healthier markets?
Or does it just pave the way for more sophisticated hype cycles that are just harder to prosecute?
That is the ultimate test. And on top of that, there's the ongoing regulatory risk. The pace of tech advancement in crypto is breakneck. There's always a risk that the regulatory framework, designed for safety, just evolves too slowly and ends up stifling real innovation.
So what does this all mean for us now?
I think it means Coinbase isn't just launching tokens. They are fundamentally rewriting the crypto fundraising playbook in the US. They're insisting that sticking to the highest legal and technical standards is the key to long-term trust and viability. This is the future.
So if this regulated model succeeds, it will solidify the idea that this kind of access isn't just a regulatory burden. It's actually the single greatest competitive advantage for securing market access and stability.
Compliance is the moat.
We really encourage you to dig into the mechanics of this new token launch platform yourself. Read through their listing standards. We've got all the resources linked in the show notes for you. Until next time, keep diving deep into the data.